Are you tired of the volatility and uncertainty of the stock market? Are you looking for a safer investment option in 2023? Well, what if I told you that buying bonds might be the answer you've been looking for? In this video, we'll explore why you should stop buying stocks in 2023 and start considering bonds as a more stable and predictable investment. So, if you're ready to take control of your financial future, let's dive in. As we enter 2023, investors are wondering where to allocate their capital. The stock market has seen extreme volatility and commodities are unpredictable at best. However, according to Michael Contopoulos, the director of the fixed income strategy at Richard Bernstein Advisors, the prospects for long-term treasuries are looking very promising. In fact, he argues that bonds could be the best asset class of the year, outperforming even stocks and commodities. While some may view this as a speculative bet, it's important to remember that bonds offer solid value and reasonable yields, making them an attractive option for long-term investors. Don't forget to subscribe to our channel and hit the notification bell to watch our latest videos as soon as they are released. As the basic reasons for buying bonds become evident again, it's worth considering this asset class as a potential addition to your portfolio. As the global financial landscape enters 2023, investors are looking for stability and predictability in their portfolios. While bonds were once considered boring investments that offered steady income, the market has experienced a major shift in the last year. As inflation and interest rates have skyrocketed, the bond market has become increasingly unpredictable, leading many investors to question their place in their portfolios. However, according to Mary Ellen Stanek, managing director of Baird Asset Management in Milwaukee, yields have already risen significantly over the last year, indicating that bonds could be back in play as a reliable investment option. Macquarie, who has compiled U.S. bond returns going all the way back to 1794, stated that it's never been worse than the last year. These startling figures are a reminder of the volatile nature of the bond market and the importance of careful investment decisions. Comment investing if you would like us to make more videos on investing. As we look at the investment landscape for 2023, it's important to understand the basics of bonds. These are loans made by investors who receive a regular income, known as yield, in return. Market yields have already risen considerably, which is an important factor to keep in mind when considering this asset class. Bond returns come from a combination of yield and price changes, which is fundamental bond MUT. When yields rise, bond prices fall, and vice versa. This effect is much greater for bonds of longer duration, which is an important measure of interest rate sensitivity. This means that a 30-year Treasury bond will be much more affected by interest rate shifts than a 3-month Treasury bill. So, if you already own a security that pays you 3% in income, and the market interest rate rises to 4%, your security will lose some of its market value. For a security that will keep paying an inferior interest rate for 30 years, the loss is much greater. The investment landscape for bonds has been anything but stable over the past year, with the leading bond index, the Bloomberg Aggregate, down nearly 13% for the year through November. Remember to give this video a thumbs up if you've watched it all the way through now, as it inspires us to create more engaging content just like this. Long-term Treasury bonds performed even worse, with representative exchange-traded funds tracking that market, such as the Vanguard Long-Term Treasury ETF and the iShares 20+ Bond Treasury ETF, down more than 26% for the same period. In comparison, the S&P 500 stock index, dividends included, was down 13%, indicating that bonds performed as badly as stocks, and longer-term bonds did even worse. This disparity is because rising interest rates have been excellent for short-term fixed-income investments, while they have been terrible for those of longer term. As the Federal Reserve has driven up the income or yield that investors receive from money market funds and short-term bank certificates of deposit, money market and CD yields, which were close to zero in January, have now reached the 4% 5% range for some money market funds and are approaching 4.5% for some CDS. This has made short-term fixed income investments a great option for investors looking to hedge their portfolios against inflation while still earning a reasonable yield. While short-term fixed income investments may be a great option for some investors, they may not be the best option for everyone. It's important to consider individual investment goals and risk tolerance when deciding where to invest. Additionally, it's essential to diversify investments across different asset classes to mitigate risk and increase the likelihood of achieving long-term financial goals. The bond market has been in a state of flux over the past year, with rising interest rates leading to falling bond prices. This has caused investors to question whether bonds are still a reliable investment option. However, according to experts, the current outlook for bonds is optimistic. While rising yields may have been problematic for traders in the past, the outlook for the future is positive. With yields now higher than they have been in some time, bonds offer much greater income potential. This income will help to mitigate any negative effects of further interest rate increases, providing a level of security for investors. Furthermore, many experts believe that interest rates will stabilize and eventually decline, leading to an increase in bond prices. If this proves true, locking in higher bond yields sooner rather than later could be a wise investment decision. Despite the rough patch the bond market has experienced, the current climate provides opportunities for investors to reap the benefits of bonds. With higher yields and the potential for interest rates to stabilize, bonds could be an attractive option for those seeking a stable, long-term investment. Investing in bonds can be a risky business, as the recent market volatility has shown. While rising yields may be beneficial if you hold a bond to maturity, actively trading a bond portfolio or investing in a bond mutual fund or ETF can result in substantial losses due to falling bond prices. However, the current outlook for bonds appears to be more positive, with bond yields providing greater income than at the beginning of the year. This increased income can help to offset any further increases in interest rates and protect against negative effects. Despite the current positive outlook, there is still a chance that bond yields may continue to rise, leading to further losses in bonds and bond funds. While the likelihood of this happening is low over the next year, it is important for investors to remain vigilant and aware of the potential risks. If inflation persists and the economy fails to slow in response to higher interest rates, longer-term interest rates could rise significantly, causing further declines in bond prices. Overall, investors need to weigh the potential risks and rewards carefully before investing in bonds or bond funds and remain aware of any changes in the market that could impact their investments.